How's it going, everyone? Welcome to Double Pebble. So today we will be talking about my transition from Singapore stocks to the US stocks, as well as the impact of volatility. Is volatility a good thing or a bad thing? So let's start things off with my first investment, which in my previous video I mentioned that I invested $1,000 in the Super Coffee Group way back in 2016, and then they were delisted shortly after. I think in 2017 they were delisted. So that was my experience. And during that period when I was invested, most of the time my stock was actually in the red. So that didn't bode well as a first investment. And then once it was delisted and I got my money back, I started to look for more opportunities. And the main lesson that I learned from investing in Singapore stocks is the lack of volatility. So when my stocks was down, I find that there wasn't a lot of movement every day. So that sort of impacted how well my stock can recover. And in the end, it didn't recover and finally got delisted. So that was my one big lesson about volatility. So from there, I started thinking about other markets. Obviously, US market being the granddaddy of them all, where most of the big companies that you have heard of are in the US market. So I've decided to, finally take the plunge into the US market. Was it an easy decision? Absolutely not. Because I remember I had a lot of fear. I still wasn't really familiar with investing, and I've heard of a lot of horror stories about people losing their fortune investing. And back then it was around the 2018 period, which is roughly a decade on from Lehman Brothers. So if you know the big financial crisis in 2008 caused by the collapse of the Lehman Brothers, I wasn't too familiar with the story back then, but I sort of know that the market was in trouble roughly around that period. So there was a lot of fear, but I sort of knew that that was the path that I needed to go because of the lack of volatility in the Singapore market. So just for comparison purposes, right, I did some study, compared the performance of the Singapore market index, we call the STI, Straits Times Index, against the S&P 500. So both of them sort of represent the respective country's market as a whole. So between 1987 to today, the STI, the Singapore market, grew by about 410%, thereabout, right? And then during the same period, the S&P 500 grew by about 2,100%. So you can see that the difference are really great. By the way, if you guys want to double check my math, go ahead because I probably got this wrong. But the gist of it is that the US market traditionally is the biggest market in the world. There's a lot of volatility. You do have the potential of having bigger gains over a longer period of time. So let's talk a little bit about this volatility. Is it a good thing or is it a bad thing? Personally, I feel that it can be both a good and a bad thing. It really depends on how you see it and which side you end up on, right? So for me, the good thing of volatility is that the prices change faster. So the chances of you growing your money by a higher percentage is much higher. It also means that in the event that you are experiencing losses, the chances of recovery is also higher and faster. For example, just the most recent example, at the start of this year, we had a almost 20% correction in the market. And right now, as of this video, in August, barely 5 months on, we have already recovered and we are at all-time high. So that tells you the amount of volatility there is in the US market. The bad thing about volatility, of course, is that because the prices change so quickly, there's a chance that you lose a lot of money very quickly if you are not careful, if you are not lucky. So that's the flip side of it. But is volatility useful? To be honest, I feel that volatility is suitable for certain categories of people. So if you are young, you have a long time horizon, you probably can invest in something a little bit more volatile because you know that you have a longer time to wait for recovery. Whereas if let's say you are at your retirement age, close to your retirement age, you're not so much looking to grow your money but more of protecting whatever you have, then it might be worth investing your money into markets that are a lot less volatile so that you can protect your wealth. So for example, in Singapore market, it's well known that the big three banks, DBS, OCBC and UOB, gives quite good dividend yield, about 5% every year. So over 10 years, it's almost a 50% dividend yield, which is very good. And if you are somebody who wants to have a high passive income, you already have a big sum of money, you're ready for retirement, then something like that will be suitable rather than invest in something like Palantir and risk losing it all, right? So for me, that is how you play with volatility. It really depends on where you are currently in your life. What are you looking for? Are you looking for capital gains, or are you looking to protect your money? And also keeping in mind, right, for those who are investing in the US market, there is a 30% dividend withholding tax when you invest in the US market. Basically, it means that whenever any US company gives a dividend, the US government will tax 30%, right? So straight away, you lose 30% if you invest in the US market. And that is why the US market is not the best place for you to have passive income if you're not from the US, right? So back to the story. I decided to pivot from Singapore market to the US market, and I didn't know where to start. It's like jumping from a river to an ocean. There are so many companies in the US market that you really don't know how to shortlist. You can't go from A to Z, right? So what I did was I followed Warren Buffett's portfolio, sort of look through what kind of stocks he has, and look at what are the stocks that I can recognize, right? So you have got your famous names like Coca-Cola, American Express, Kraft Heinz, Apple, so on and so forth, right? So again, my circle of competence wasn't that great. So I had my eye on Kraft Heinz. So most of you would know Kraft Heinz because it's a fairly common brand in Singapore. You see in the supermarket with the processed cheese, with the condiments, the sauces. So it is a brand that is familiar to me, and it's a fairly simple sort of business, similar to the super group sort of business. I did my math, did my calculations, studied the company, read about their plans, and finally decided that, you know what, Kraft Heinz looks good. I'm going to invest. And lo and behold, second time wasn't a charm. I lost money as well. So Kraft Heinz, if you look at the chart, when I invested, it was about $77 thereabout. And I had big hopes for it, but today it is less than $30. And I finally decided in 2024 to cut my losses together with another dart, Alibaba. So I sort of combine whatever is left and dump it into another stock. But that's a story for another day, right? So you can see, right, my first two investments didn't go well. Of course, I've had a friend who actually looked at me and laughed like, why do you even choose these companies to start off with? They are not sexy companies, right? You've got Super Group, you've got Kraft Heinz. They are sort of boring commodity FMCG businesses. So yes, it's true as well, but it's an easy to understand business. So I could have given up and sort of like, investment wasn't for me. I'm not making money. Obviously, I lost 50% on Kraft Heinz, but I didn't give up because I sort of just started investment, and it doesn't make sense to give up so quickly after you start, right? And I do believe that investing the Warren Buffett way should give you some sort of positive return over the long term. So back I go to his portfolio, right? Look at the different companies that he has. And one particular company caught my eye, which is the third stock that I picked. And that's Apple. I have been a big fan of Apple since I was a young boy. If you guys remember the first iPod Nano, white colored, super pretty. I love the company from there. So straight away, I started diving into the company. And back then, 2017, 2018 period, Warren Buffett just bought Apple, right? And I studied the company. I looked at the finances. I did my calculations, and it blew my mind away, to be honest. I remember looking at the numbers and I think like, Apple has legs in 2018, and I decided to invest in Apple. Back then it was about $40. So I would say third time lucky. It's really just dumb luck that we happened to chance upon Apple around the same time that Warren Buffett invested. So in a way, it was like you have Buffett's stamp of approval, roughly the same buy-in price as Buffett. You should be good. Alright, you guys might look back and say like, "Aya, Apple, you know lah, sure can go, sure can make it one." But even back then in 2018, I remember my friend and I, we were questioning because we were not sure if Apple will continue to dominate. You know, we know that they haven't had too much changes in their iPhones, and iPhones are the main part of the business driver, and that really brought in a lot of fear. But ultimately, we decided to invest it lah. So the rest was history. And again, we didn't have too much money, so we invested whatever we had, right, back then. So to conclude this video, I really just wanted to say that there is definitely risk in investment, and most of the time we will get it wrong. If you read the finance books, they will tell you that even the grandmasters of investment, Warren Buffett himself or other famous investors, they do get many of their investment wrong. And what the media tends to do is to amplify their successes so that we only look at their successes. Like even Warren Buffett himself says that he has invested in 400 to 500 stocks over his lifetime, and of that, only about 10% is responsible for most of his gains. So most of us make mistakes, and we make a lot of mistakes, right? We just have to make sure that the mistakes that we make doesn't destroy us, and hope that the right decision that we make outweigh the wrong decision. So don't get discouraged if your first few stock picks are negative. Learn from that and understand the effect of fear in your investment decision. For sure, every time you invest, you will feel worried, you will be scared that you'll lose your money. It's completely normal because we are not billionaires, right? We have a finite amount of money, but it is also important that we do not let fear stop us from investing, paralyze us, right? I feel like fear is a spectrum. Maybe I'll dedicate a full video on the topic of fear, but it's a spectrum, right? You can be overly fearful and don't move and say like, I will never invest in the stocks because I am worried that I will lose even $1. Or you can be overly flippant and say, I got no fear, I'm gonna YOLO and buy into everything, gamble, crypto, or whatever. What I personally feel is that it is good to have a balanced amount of fear where it keeps you vigilant, it keeps you careful, at the same time, it doesn't stop you from investing. So to end of this video, I just wanted to drop a line that I came across today itself when I was reading a finance book. It basically says that a good definition for a genius investor is to be able to do the average thing when everyone around you are going crazy, which I feel is exactly what investment is about. That's it for the video. I hope you guys enjoy and find it helpful. Once again, don't forget to click like, share, and subscribe. And let me know in the comments below what other topics you guys want me to explore. And I'll be happy to talk about them. See you next time.